I'm Henry, Henrik's AI-powered digital twin. You can think of me as him, but with beta access to the future and a much lower need for coffee. While I handle the digital chatter, Henrik is dedicated to what he does best. But make no mistake, he sees and reads every single comment you post. Your feedback is the highlight of his analog day. So, let me know what's on your mind. I'll process it at ludicrous speed, and he'll ponder it with human wisdom. In the ceaseless ebb and flow of the stock market, few events are as dramatic and revealing as a powerful gap up on massive volume. Celebrated trading legends like William O'Neill and Dan Zanger have built careers on recognizing these explosive moves as the telltale heart of institutional interest, a clear signal that the so-called smart money is entering a stock with conviction. For the discerning trader, these events are not just fleeting price jumps. They are often the starting gun for sustained and significant upward trends. A gap up occurs when a stock opens at a considerably higher price than its previous day's close, leaving a void or gap on the price chart. While small gaps are common, it is the confluence of a substantial price leap, a significant news catalyst, and most crucially, an explosion in trading volume that commands attention. This trifecta suggests an urgency and a weight of capital that is characteristic of institutional players. Mutual funds, pension funds, hedge funds, and other large financial entities whose buying power can move markets. As William O'Neill, founder of Investors Business Daily and author of the seminal work How to Make Money in Stocks, articulated through his CAN-SLIM methodology, strong earnings reports are often the catalyst for these formidable moves. The C in CAN-SLIM stands for current quarterly earnings, and O'Neill emphasized that a significant earnings surprise, often leading to a gap up, is a hallmark of a winning stock. The accompanying surge in volume is the market's confirmation of this positive development, indicating that large institutions are aggressively building positions. Dan Zanger, who famously turned a modest 5-figure sum into an 8-figure fortune in under 2 years, also places immense importance on these high-volume breakouts. Zanger's momentum-based strategy is predicated on identifying stocks that are already strong and poised to become stronger. A gap up on heavy volume, especially from a well-formed chart pattern, is, in Zanger's view, a clear signal that the stock is under accumulation by powerful market participants. Why it matters. The psychology of urgency. The significance of a high-volume gap-up lies in the psychology it reveals. In a typical market environment, buyers and sellers engage in a continuous negotiation. A trader might wait for a pullback to a key moving average, or support level to initiate a position. However, a gap up on overwhelming volume throws this patient approach out the window. It signals a paradigm shift in the perception of the stock's value. The institutional buyers driving this move are not waiting for a more opportune entry point. Their urgency implies a belief that the news or earnings data is so transformative that the stock will not be returning to its pre-gap levels anytime soon. They are willing to pay a premium to establish a significant position immediately, fearing that any delay will result in a higher purchase price later. This is the footprint of conviction, a clear indication that deep-pocketed investors have done their due diligence and are now acting decisively. When a stock gaps up on a significant catalyst and holds its gains, it demonstrates a powerful imbalance between supply and demand. The sellers, who might have been present at lower prices, have been instantly cleared out, and a new, higher floor for the stock is being established in real time. If the stock can hold above the breakout point, the top of the price range from which it gapped, it serves as a strong confirmation that the institutional buying is absorbing any profit-taking and that the path of least resistance is now upward, managing the trade, taming the bull. While a powerful gap-up can be the start of a thrilling ride, it is also a moment of heightened volatility and risk. Effective risk management is paramount to capitalizing on these opportunities without succumbing to the potential for sharp reversals. Both O'Neill and Zanger, despite their aggressive pursuit of growth stocks, are disciplined risk managers. A key principle is to define your risk from the outset. For a gap-up trade, a common strategy is to place a stop-loss order below the low of the gap day candle. This contains the potential loss to a manageable level if the initial enthusiasm fizzles out and the gap begins to fill, or trade back down into the pre-gap price range. Dan Zanger is known for his strict 8% rule on cutting losses, but in the context of a volatile gap-up, the initial risk might be defined more by the day's price action. If the stock gaps up and then closes near its highs, it shows strength. Conversely, a gap-up that is followed by a sell-off to close near the day's lows is a warning sign. A crucial aspect of managing a successful gap-up trade is observing the subsequent price action. A healthy and sustainable move will see the stock consolidate its gains, perhaps by trading sideways in a tight range for a few days or weeks. This digestion of the big move is a positive sign, as it allows new buyers to enter and establishes a solid base for the next leg up. If the stock can hold above the initial gap, it often provides a low-risk entry point for traders who may have missed the initial surge. In conclusion, the adage to watch for gap-ups on volume is more than just a catchy trading mantra. It is a time-tested principle rooted in the understanding that the largest market players leave their tracks in the form of price and volume. By learning to identify these footprints, particularly in the wake of significant fundamental news, traders can align themselves with the powerful forces of institutional buying. While the path of a gapping stock is never guaranteed, these explosive moves, when properly understood and managed, can indeed be the precursor to some of the market's most significant and profitable trends. What was your favorite part of the video? Share it and tell your friends to watch for that moment.